So in today's training, we're going to be looking at candlesticks, price action, and we'll see how this can help us become effective traders overall, and how we can probably profit from the market. Becoming a pro analyst, price action candlesticks. In our previous courses, if you're here and you've not watched the previous, you did not you're not part of the previous trainings, then you might want to go and see that. That's if you have no trading experience. So there we explain some of the basics of trading. Because now, from now on, we'll be looking at more in depth, and I'll be assuming that at least you understand some of the basics of trading. So if there are things that I've covered in the previous class or previous trainings, then I may have to skip your questions. You know. Okay. So as usual, this is the disclaimer. When it comes to trading, there are risks associated with it. So want to trade with money uh, that we can afford to lose. Let's put it like that. Just as there are risks associated with anything. So in today's content, we'll be looking majorly on candlesticks. We'll look at what story they tell. We'll also see how candlesticks serves as sign language to the forex markets. And we'll see how we can trade these candlesticks. The pointer here is that after today's training, you should be able to take trades, like make well defined trades in the market based on what you've learned. So let us begin. Candlesticks and the story they tell. Well, if you are new to trading, then when you pull up your chart, it looks very confusing. I wouldn't lie, it looks really really confusing, and so I would understand some people's what am I looking at here? How do I make sense of all the chaos? So we'll see what we can make of that, or how we can break that down. In the previous lectures, we talked about how what candlesticks are and how they function. They show us the open price, the low price, the high price, and the close price. Now, the shapes of these candlesticks also make a lot of they tell a lot of stories. So the shape, the size of candlesticks, and the way they form, and sometimes a combination of two or more candlesticks can give us an insight into what could possibly occur and how price could possibly move. So each candlestick, since it represents what has happened in a particular market in a specific period of time, if you understand that some candlestick form over time, they do the same thing over and over again, and you can look into taking advantage of that particular candlestick trading. So we're going to be looking at candlestick trading today. Now let us look at some of the candlestick patterns. I'm a little bit fast here so that we can go to the chart and see these things in practical. So here are some of the candlestick patterns, the key candlestick patterns. Remember, we said bullish means something is about going up. Let me just put it like that: going up or trending higher. And then bearish means going down or trending lower. Well, here are some examples of bullish candlestick formations. So in today's, we'll be looking at the three major candlestick patterns and how to trade them. So you have the first one, the bullish candlestick pattern. You have the hammer. If you can look at this candlestick here, the hammer is a single candlestick pattern. So the hammer, it forms, and then you see how the candle looks like more like a hammer. And if you notice, the candle preceding it, we are coming down, and then when the candle forms, it now start taking price up. We also have the inverted hammer, the dragonfly, the bullish engulfing, the piercing line, morning star, doji morning star, and three white soldiers. Now, the key ones that would be the key ones that we'll be looking at. The key ones that will be sorry, can you see my screen? You can't see my screen. Oh, really? Okay. Sorry. I've been explaining without my screen. Okay. Sorry about that. Okay, so I'm going to quickly speed up to what I was talking about. So this is where I was. So these were the candlesticks I was trying to explain. I hope you can also see my screen now. Okay, so these candlesticks at the top here are bullish. They form when they form, they give us an indication that the market is about to turn bullish. Means the market is about to move higher. And these ones at the bottom, when they form, they show us an indication that the market is about to move lower or turn bearish. So the first one I was explaining here was the hammer. If you look at the candle, it looks like a hammer. It looks like Thor's hammer. So you can see that the candles preceding it were coming downward, and then after hitting or forming this bullish candle, this bullish hammer, it start pushing price up. Now the same thing with you have the inverted hammer, the dragonfly doji, the bullish engulfing pattern, the piercing line, the morning star, the morning doji star, and the three white soldiers. So these are just fancy names given to them. But the key thing is the candles that form, what they look like, and where they occur. So there are three basic ones that are, they give us a lot of insight. If you can master trading those candlesticks, you can already become profitable if you know how to trade them well. The first one is the hammer. So both the bullish hammer and the bearish hammer. They call it either you call it a pin bar or a hammer. So if you look at it in this case, it is pushing price up, and in this case, it's inverted, pushing price downward. So you have the hammer, the engulfing bar, engulfing pattern, and then you have the inside bar, which is this dark cloud cover of this. Now we'll look at the chart. We'll pull up a chart and we'll show this is an example. So we're going to be working with the chart almost all through the course today. And so I am assuming that you know how to set up your charts. And so now if you look at the markets or this, we're looking at the Euro USD, the 1 hour time frame. And it doesn't really matter the time frame, although I prefer to trade from the 1 hour time frame to the daily time frame. And most of these patterns they are more significant in the 1 hour time frame. So we'll begin with the bullish or the pin bar. Let's use the pin bar, both the bullish and the bearish. If I go back to the slide, you'd see that this candle formation, yeah, this candle formation, the hammer, it has an appearance where you have a small body and a long tail. So when it's occurring it is forming a bullish formation, you'd have it form in such a way that the market moves down, way down to this point, but before the close of that particular period, it went back and closed very close to the open price. So this pattern, what it shows is exhaustion. So you can see that the market has been coming down, and then when the market got here, it actually went down as low as this point. But at the end of the day, rallied back up and closed here. So you can this long tail here shows that sellers pushed price down very low, but buyers refused to allow price get to that low point and pushed price back up. And so this now turned the momentum in the favors of buyers, and you can now see the price moving up. Now you might want to see this in the chart, and that's what we're going to do. So let's go to our chart and we'll look at countless examples of this. So any time frame, any currency pair, it works. Now this is we can just scroll back and you will see examples of this. Now look at this here. You can you see this pin bar here or this hammer. Market has been trending down, obviously. And then it forms this pin bar. And then what happened next is you see how it pushed price back up. Now this is a how many pip movement? 53 pips move. And it took what? 6 hours to make. Now you can see how there's a counter example here. So that is for a bullish hammer. If you move, if you say if it would search, you don't look at it. This is also a hammer, and the what makes up a hammer or a pin bar, it doesn't matter the content or the color of the candle. What is more important is the long tail. So what will qualify as a hammer is one that has a long tail. If it's a bullish hammer, it has to have a long tail at the bottom, and then the body of the hammer can be either bullish or bearish. It doesn't really matter. So like the body of the hammer can be bullish or bearish, or even like you can see in this case now, it's almost as if there is no body, as if it opened and closed at the same price. So you want a long tail, small body, it can be bullish or bearish, and then a very small head or tail at the top, if any. If it doesn't have, better. So when you see a formation of such, it gives indication that the market is about to move in the opposite direction. Now, this doesn't mean that the market will always move in the opposite direction and maybe continue in that direction, but it gives you an indication that the market would at some point, or is that there's a tug of war between buyers and sellers, and so because of this tug of war, maybe if the market has been trending down and then you have this bullish hammer form at a support level, then you can see what it is saying is that buyers are refusing to allow price go lower than that particular point. Or maybe if it happens at the top, it means sellers are refusing to allow price go higher than that point, and it now pushes price down. So any time frame, any currency pair, you can trade this pattern. Now let us see how to trade it. How can you trade the bullish hammer, or how can you trade the hammer in general? So if it's remember, if it's a if it's happening at a point of support, that means at a low price, it is a hammer. If it's happening at a high price, it is a pin bar or an inverted hammer. So in this case, you can see a hammer form here. You can, I can see several hammers here. You can see one here. Now let's use this for example. How do you trade this? If you want to trade the hammer or the pin bar, so I'll be calling it a pin bar so that I don't have to refer to it as bullish or bearish. So in this case, it's a pin bar, a bullish pin bar. Now, it formed at a low price. So you can see, first of all, what you want to identify is what has price been doing. So if price has been coming down and then you see a bullish hammer, it suggests that price would very likely start going higher. Now, if price have been going up and then you see a bearish timber or a bearish hammer, then you can now, it suggests that price would very likely start dropping. Now, how do you trade this? You have several options to trade the hammer. One of them is after the candle has closed. Remember, the hammer is not formed until that particular candle has closed. So if you're looking at a 4-hour time frame, then let's assume this candle now is forming a hammer. It is not yet a hammer until this candle has closed and the next one has opened. Now, in this case, if we were to trade this hammer, this particular one here that I have my cursor on, after the candle has closed, we have three options. The first one would be start buy at the market price once at the close of this candle. So at the open of this candle, you buy. Now, yeah, before when you place a trade, there are two things you want to know. Three key things actually. The entry price, where are you entering the market? The second one is where will you exit for profit? And the third one is where will you exit in case of a loss? Now, if you if you are buying this pair, you for the first entry price, you want to enter at the current price. So once this candle close, you want to start buying. So you buy here. So this is where your entry will be at this level here. So somewhere around 1775. Now, your exit for loss should be about 10 pips below the low. So if we are buying in this case, it will be 10 pips below the low of the lowest price of the hammer. So now if you look, the lowest price of the hammer is 1756. That means our stop loss will be placed at 1746. So somewhere here. Now this is not cast in stone. I mean, it doesn't mean that you have to place it there. Depending on what I'm looking at, depending on where support and where I feel support and resistance level is, you might want to adjust it. But as a basics, you want to place it 10 pips below the low. So this is the entry price. If you hover over this candle, you can see at the top here, this is open, high, low, and close price. So you can see here that the low price is 1756. That means you place your stop loss 1746, somewhere here. Yeah, so somewhere here. Then you take profit. You have options to take profit. So you can either take profits at the next support of buying. You might want to take profits at the next. Oh, okay. I'm going to try and make it bold. Okay. So okay, so I'm going to try and make it bold. I think you're saying it's too small. Okay. I hope it's bigger now. If I make it too big, you wouldn't see. I would like you to see what has been like. See a lot of the charts. Let me make it this big. Okay, so now, like I was saying, the bullish pin bar appeared here, and it shows us, and it appeared after price has been coming down. So what we want to do is the first entry, we'll buy at the market price. So as the pair close here, would buy. So that means our entry price is 1758. So we have our entry price at 1758, so 1.17. And then our stop will place 10 pips below the low of this candle. So you have the low of this candle at 1756. That means if you subtract 10 pips from it, you know how I'm getting the pips. I mean, if you look at the right hand side of my screen, you'll see the price there. So at 1756, if you remove 10, it will be 1746. So 1746 is our stop loss. Now our take profits. Not normally you might want to put your take profit at the next support or resistance level. So in this case, we are buying. So at the next resistance level, you would out would in some in our later course would explain support and resistance better. Can you see my screen? Please don't share your screen. Do not present so that it doesn't take off. It does not take off. Please don't share your screen. Just watch what is going on my screen. Okay. Now, so your entry is here. Your stop is 10 pips below the low of the candle, and then your take profit is at next resistance level. Now, the if you are taking this trade, you'd have the next resistance level is somewhere around here, which is around 89 pips. So in this is 1, 2, 3, 4, 5, 6, 7, 8, 9. In 9 hours, you'd have made 89 pips. Now, if you were trading a standard lot, that would have been $890. If you were trading a mini lot, that would have been $89 in 9 hours. If you were trading a micro lot, that would have been $8.9 in 9 hours. And this is using the pin bar trading strategy. Now, it is also quite similar if you're trading the pin bar. Remember, this one we're looking at is the bullish. That means price has been coming down and then it appeared and it pushed price up. You can, and then another thing to take note of is nothing is certain in the market. So it doesn't mean it would always work. It doesn't mean when you see a pin bar, you carry all the money in your account and decide to buy or sell. That is the reason why we place stop loss. You can see a pin bar form here too. Although it pushed price up, after the pin bar formed, although it pushed price up, it didn't push price very much high, and then I think by around here would have been closed out for stop loss. So when you understand support and resistance, you'll be able to now combine all of these things together and make better trading decisions. In our class tomorrow, we'll be looking at support and resistance. But for now, we're looking at trading the pin bar. So imagine you're trading all the pin bars you see. And so when you're trading pin bar, or you want to be doing it on the either the 1 hour time frame or the daily or the 4 hour time frame or the daily time frame. That is the best place to be looking at it. On the 30 minutes and the 15 minutes, you would see pin bars, but because it's the market is the is so many things are happening within 15 minutes, you'll be getting a lot of stops out. So now let us look for an example of the bearish pin bar, and then we'll see how we can trade it. I think I see one here. See how we can trade it using the second alternative. Remember, for the first one, we enter at the current market price. Now, the next option will be to enter at a 50% retracement of the candle. Now, I hope you can see my screen. You see this pin bar here. So if you can see this pin bar candle, this is a bearish pin bar. And we say it's bearish because if you see, the price has been going up. And then you can see the price is stalling. It is refusing to go higher. And then a pin bar appeared. Now, this pin bar appeared, and afterwards, this happened. You have a massive drop in the market. So now let us look at trading this bearish pin bar. Now, if we were to trade this bearish pin bar using the second example, what we would do is look to enter the trade at a 50% retracement of the candle, meaning we'll place a stop a buy, sorry, in this case a sell limit order. So we'll place a sell limit order that okay, when the market comes back to half of this candle or 50% of the candle, then you want to sell. Our stop loss placement will still be the same, 10 pips above this, and our take profit will be at the next support level in this case, or the next area of support. You can also take profit you can just put your stop loss and then take your profit when you've seen your profit. Some people do that. So you can just, if you see $20, you've seen $4, you've seen $5, you close your trade. You don't have to leave it till it gets to take profit or stop loss. You can close your trade whenever you like. But if you're trading, you want to put your stop, if you're trading the pin bar, your stop loss at least 10 pips above the high. In this case, the high is around 1947. So our stop loss will be at 1957, something like 1957. Somewhere here. That's where our stop loss will be. So that means we would have entered at a 50% retracement of the candle. Now, see the importance of placing your stop loss some pips above the high. If you notice, the market did not just start going down. It first of all went up. So if you have placed your stop loss exactly at this high, you'd have taken a loss because the market would have taken you out here. So by giving the market room to move and placing your stop loss at least 10 pips in, if I were the one trading this pair, my stop loss would have been not just 10 pips above the pip high, but above 5 pips or 10 pips above this swing high. So this is by swing high, this is the most current high that we can see. So I'll place my stop loss here. Now I'll take profit would have been at the next support level. And the next support level I can see in this chart is here. So that means I would have taken profits here. And that would have been a movement of 77 pips. And this is around maybe 6-7 hours max. Now, because we're looking at 1 hour time frame, each candle doesn't move that much. If we're looking at the daily time frame, if a pin bar appears in the daily time frame, the price movement is high. It also means that your risk movement is also high. Look at this pin bar that formed here. I traded this particular pair. So look at this pin bar that formed here at this high. If you follow our social media channel, I think I posted this particular currency pair and how I was trading it. Now, when this pin bar occurred, this was last week or 2 weeks ago. Now, when this pin bar occurred, if you use the first method, which is you enter the trade at the close of the market, and when this candle has closed, that means I entered from here, and that is 150 pips in 5 trading days. If you're using a standard lot, that is $1,500. If you're using a mini lot, that's $150 in 5 days. Now, your stop loss too in this case would also be above this swing, this high here, and then your take profit will be at the next area of resistance or support. You can see the market has been struggling here, and that is why my profit taking was there. So you can either take your profit at the next area of support or at the next candlestick that formed opposite to the direction. So you've been selling, and then you see this bullish candle form, and then you might now want to take your profit, and that would have given you some handsome profit. Now you can see that if you use the first technique of trading or the second technique, they both have their advantages and their disadvantages. In the first one, you enter at the current at the close of the market candle, so you're going in, but your risk is higher. In the second one, you are waiting for the market to retrace to come up, and then your risk is lower, but sometimes the market may not come up, and so your trade will not be executed. So you'd have not taken part of that trade. So they are both pros and cons. Personally, I normally wait for 50% retracement in some pairs, and in others, I just trade at the market value. Now, if you're wondering how you can figure out where the 50% retracement is, or where the 50% or the half of the candle is, there's something called a Fib tool. In some later discussion, would look at Fibonacci properly. But this is how you get the Fib. If you use the Fib retracement, you can just pull it from the low of the candle to the high. Okay. Okay. I hope you can hear me. Someone is asking if my mic is on. Okay. So the 50%, okay, this is not clear. Let me change the color of that. Bold, solid color. Okay. So this shows me if you look closer, let me zoom in. So you can see the 50% or half of the candle, which is this. So you can use that to get exactly the 50% retracement. But for now, that does not cover our scope of discussion today. Is not that does not include it. We look at Fibonacci proper. Fibonacci is a powerful trading technique in some later courses. But that is how you trade the pin bar. Now let us look at another example of another type of candlestick formation, which is the inside bar. So you have the okay. So the inside bar, remember the pin bar is sorry about that. Okay, so the pin bar is used to trade. It shows us that the market is about to reverse. That means you need the market to be making the trend, so either coming down and then the pin bar appears and it shows you that price is about to go up. Either way, if it's a bullish or if it's a bearish. But the inside bar is used to show us continuation. That means you're trading in the continuation of the trend. So when it occurs, you're looking to trade the market in the same direction that the market is moving. The pin bar, when it occurs, you're looking to trade in the opposite direction of the market. But the inside bar, we're looking to trade at in the same direction of the market. Now, this is what the inside bar looks like. It is a combination of two candles. Remember, the pin bar is just one candlestick formation. But the pin bar, the inside bar actually, is a combination of at least two candles. So you have a mother bar which is bigger than, which completely swallows up the child bar. Let me put it like that. So you have the mother bar which completely swallows up the child bar. So you have a bigger candle, then a smaller candle which is the high, both the high and the low is contained inside the mother bar. So when you see this kind of candlestick form in a trend, you are looking to trade in the same direction of the trend. Now let's look for some examples of inside bar on our charts. Okay, so Remember, first thing you're looking for is a trend. So you want the market to be making a trend. So let's look for a trending market. Okay, so look at this, although this would not really qualify because the market has not really started trending. But up, all the way from this, you can see all the way from this here now, you can see the market moving higher. So at this point where the market stalled, it formed, I thought it's okay, there's a pin, an inside bar here. So you have this inside bar here. Now this is not as clear as I would have liked it to be. Okay, let me use this one. Yes. So you have the market trending higher. So you have as the market is it's clearly making higher, going up, and then you have this candle that formed, which is completely engulfed. If I'm not mistaken, where is it again? Okay, so I don't think this is the one I was looking for, but this will serve. So the market has been moving higher, and then you have this candle which is completely covered both from head to toe by this mother bar. So both the high and the lows is bigger, and the high and the low of this one is completely engulfs it. Now, this, like we said, is a continuation pattern. That means the market is moving in upward direction and it forms. You want to trade the market in the same direction that it occurred. So this, when you see this kind of candlestick form, the way you want to look to trade it is to place a a buy stop. Um, so a buy stop order, I think I explained it in the previous lecture. A buy stop order is an order you place to buy the market at a future higher price. And then a sell stop order is one you place to sell the market at a future lower price. Then a buy limit order is one you place to buy the market at a future lower price. And to sell a sell limit is the one you take to sell the market at a future, um sell at a future lower price. I think I've mixed that up. But it's in this case, what we're going to do is place a buy stop order. That means we want to buy the pair after this candle has formed. We will not just buy, we will not just enter buying. What we'll do is wait for the market to close above the mother's bar high. Now, because this is a bullish, inside bar, we'll place our entry 5 pips above the mother's bar high. So if the mother bar is the high of the mother bar is, let me see, 1063, we'll place our entry at 1068. So 1068 will be our entry. So somewhere there. And then our stop loss will be 10 pips below the mother's bar low. So our entry 5 pips below the mother's bar high, our stop 10 pips below the mother's bar low, and then our take profits at the next resistance level or when you've seen enough profits. Now, in this case, our entry would have been somewhere here and our stop would have been here. But notice that we have not bought the pair until the market gets to that high. That means even when this occurred, we are not yet in the market. That means we are not even bothered. Our trade will be triggered in this candle. So somewhere here, that is where our trade will be triggered. And then we will take that up to this, which is around 93 pips. So that is how you trade the inside bar. So you look for the market to be trending higher, and then when it forms, you are going to set a stop, and this is how you set a buy limit. So if you're using your phone, it's also quite similar. You just click on the plus. There's a plus button at the top, or you place on new order. You click on new order, and so what you want to do is select the lot size that you want, and then you put in when you've calculated. Remember, we've done our analysis and we know where we want to put our stop loss. You put in you but first of all you put in the type of order, so you put in a pending order. Now, market execution order is the type of order where you're buying at the current market price. But if you're placing an order to buy at the future price, you use pending order. Now, we are buying at a higher price. Remember, all of this has not occurred. So we are buying at a higher price. That means we are doing a buy stop. So a buy stop order is to buy at a higher price. And then you put in the price you want to buy. So in this case, the price we'll probably be looking to buy is let's say 1076, then we use, so that's around 1.1076, and then your stop loss will be 10 pips below this one, below the low of this, so which is around, is somewhere here, 1.0985. So here you put a stop loss of 1.0985. Remember, this market, this has already occurred. I'm just showing you what you would have done, and then maybe your take profits would have been at 1165, and you'd have just placed your order. Now it's saying invalid because in the current market, you see price is not at that level. That would not be a buy stop actually. That would be actually a buy limit because price is now below it or above it. But that is how you trade the inside bar. It's also similar when you're trading it selling. You know, we showed an example buying, and then it's also the same when you're using selling. Let me see if I can look for another pair that is trending and show you. Okay. Okay, so look at this. See one here. Okay, now if you look closely, you would see that the market has been moving, has been coming downward. Market has been trending lower. And then you have this occur. So you have this inside bar. So you see the market, there are a lot of inside bar here actually. So there's one here, there's also another one here, and I think there's also another one here. Now let's use this. So the market has been coming down, and then you have this inside bar form. In this case, we are selling. So what you do is when the candle has formed, remember you have to wait for the candle to completely form on the time frame you're looking at it. So once the candle has completely formed, what you're going to look to do is sell. But you're not selling instantly. You're going to use a pending order and sell at a future lower price. So you sell 5 pips below the low of this candle because we're selling. So 5 pips below the low, the candle is 73.59. So around 73.53 or 54, that's where we'll be looking to sell. Our stop loss will be 10 pips above the high, so somewhere here, and then our take profits would either be next resistance or support, next support level, or when you see a turnaround. So in this case, this is the reason why we don't just automatically start selling or start buying. You see that the market did not just start moving down; it actually started going up first. But then it came down. In this candle here, our order would have been taken in. And you see, after it took us in, the market never went the other way. It was just down. So it was just ruin of profit. So that would have been what if you have closed there, that would have been 54 pips. If you've written it down to here, that would have been 104 pips. And this is so maybe 2 days, 1.5 day of trading, and you'd have gotten that. So that's the same thing here. You can also see an inside bar here. The market has been coming down. It formed the mother bar. So actually, you see this big bar, although this one is not. You see this one. Now you see this one completely engulfed inside. Would have placed our trade 5 pips below. So 5 pips below this low here would have been somewhere here. Now, all of this while our trade is not in the market. Our trade will only trigger when the market comes down here and take us in, and then we'll ride straight down to the end. So that's how you trade. That's how you trade the inside bar. Now, the next type of candlestick formation that we're going to look at is the engulfing bar. Now, the inside bar is a continuation pattern. That means in the same continuation, the same direction that the market has been moving. The pin bar is a reversal pattern. That means in the opposite direction, when it forms, it shows us that market may start moving in the opposite direction of the market. Now, an engulfing bar is a type of candle that forms that it shows us a reversal pattern too. So when it happens, it's telling us that the market is about to move in the opposite direction. Now, what does an engulfing bar look like? That is what an engulfing bar looks like. It looks like this. Like this. So you have a candle. If it's a bullish engulfing bar, the market will be trending down. That means market will be moving lower. And then you have a candle, a bullish candle, that will now form and completely cover at least at least the next, the previous candle that was close to it. The more candles it covers, the better. So if it can cover one or two or three or even more, so the more candle it covers, the better. But basically, you're looking at it covering just the previous candle. So when you have a candle or a candlestick formation like this or core in the market, first of all, you want to see the market moving down, and then you want to see a bullish candle or core majorly at areas of support and resistance. But because we've not talked about support and resistance, I'm not going to bring that in yet. But when it occurs, you're going to look at the market moving higher. Now let us go to our chart and see if we can spot some examples of a bullish or a bearish engulfing bar. So a bullish engulfing bar, okay, this is one here. There's one here. So you have, although this market has not really been trending, let us look for, okay, um, let me go to another pair. Okay, now you have for a bullish. Remember what we said about the bullish engulfing bar. The market has to be trending. That means it has to be moving in a particular direction. And then when it occurs, it shows you that the market is now poised to move in the opposite direction. So the market might be, if the market has been coming down, you'll be looking to see it at a low price. So if the market has been going down, you want to see it happen at a low price so that it signifies to you that price is about to go up higher, and then you buy. There's no, I'm seeing a lot of pin bars and inside bar here. Let me, okay, let me change time frame. Okay, okay. Now, here is an example of a bullish engulfing bar. So you have the market trending higher or trending, you see the market going up. And then what you're looking for is a candle that forms and covers, either covers it completely from top to bottom or covers it, just almost covers it. So like in this case now, you have this candle completely cover it. Although this, okay, look, let's use this now. So you have the candle completely covers, the market has been going up, and then this bearish candle formed against the trend, and you see how it pushed price down. Now this push is what? 130 pips, which is around $1,300 if you're trading a standard lot. So what you're going to be looking out for is for the candle to form against the trend. So the market, if the market has been going down and then you see a bullish engulfing bar occur, it signifies that the market may start going up. But if the market has been going up and then you see a bearish engulfing pattern occur, it suggests that the market may start dropping. Now, how you trade this too? You want to enter at the close of the bullish engulfing bar and then take profit at the next support level. That's if you're selling. And your stop loss should be 10 pips above the high of the candles. So 10 pips above the high, your take profit, the next support or resistance level, and then you're good. The other entry will also be to do a 50% retracement of the bullish engulfing bar. Place your stop loss, same 10 pips above the high, and you'll take profit at the low of the candle. Here is also an example of a bullish engulfing. It's not exactly clean. You see the market trending down, and then a candle forms. This candle completely covers the previous one from head to bottom. Not just the body of the candle, but both the head and the tail. So it completely covers it, and it push price up. But basically, if you're new to this, you want to be looking for candles that are clean. You want to look up for candles that are clear to see, they form clearly to see. And then once you have them form like that, what you want to do is take your trade. Now, the reason for your stop loss and your take profit is because all the trades you will take may not may all the trades you will take will probably not go your favor. So if you don't have a cushion you start seeing a lot of loss in your account. So if imagine if you were trading pin bars and bullish engulfing bars and inside bars, how good it would have been of trading. So best of all is when you have a combination of them. Now, if you see, let's say in a low price or at a high price, a pin bar form, a bullish engulfing bar forms, and maybe while the trade is moving, an inside bar forms, it just gives you, more confirmation to your setup, and you see a lot of that. Sometimes before, because the ones the market forms. So let's see this for example. You have you have a So you have a pin bar form, and then you now have another bullish. Not This is not exactly a bullish engulfing. This is actually a dark cloud cover. It's called the dark cloud cover. But this is also a bearish signal. So you have one here that signifies weakness in buyers. That means buyers are losing strength. And then you have this dark cloud cover, this big bearish candle form that also supports this one you've seen. You also had a bullish and a bearish engulfing bar. You can see a bearish engulfing bar completely covers this up. A bearish pin bar form and a bearish dark cloud cover forms, and then you see the price run down. So the more combination of it you see, especially when they happen at areas where prices have reacted to in the past, then the more likely that you have a good trade in your hand. Now, all of this candlestick formation would now become more in depth and make more sense when you understand support and resistance. So how to draw your support and resistance level, how they work. When you are able to figure out areas of support and resistance in the market, so you can now know what you're looking for, because you cannot just open the chart and start looking for what to do. You'll be seeing a lot of things that will not make sense. So when you understand support and resistance better, then you now have a better edge in trading this. But for now, if you're new to trading, what I need you to do is look at your charts, look for these patterns that we've seen, that we've learned about, and see how much you'd have made trading them. So this is a pin bar, this is a bearish engulfing, this is an inside bar. This is not exactly okay, yeah, this is an inside bar, but this would have given you a loss. So in this case, would have taken a loss, not necessarily, because our stop loss would be 10 pips above. So our stop loss would be maybe somewhere here. We would have taken a loss or not. But the trade is not exactly clear because this one did not move much. Now, identifying these candles when they form, I think there was a trade I took. Let me see. Let's go to the end of the chart. Okay, so in this case here, I'm actually still in this currency pair. So after this, you can see this bearish engulfing bar over here. So the market has been trending and have this bearish engulfing bar form here. And so after this candle formed, I entered at the 50% retracement, and my stop loss is above here. Actually, my stop loss is above here because of this swing high here. So my stop loss is here. Now, my expectation is for price to drop at least to this point. And then if the price breaks below here, I might look to trade it up to this point. Now, this is how you use a combination of, although it wasn't just the candlestick that caused the entry, but the candlestick was the major place. This is how you use candlestick to make trading decisions. So what you want to do is demo it. So in your demo account, you want to be able to look for these things, take trades, focus mainly on the 4 hours and the daily time frame, because that will mean that you don't have to look at the charts too often. So if you use a daily time frame, that means it takes 1 day for a candle to form. So if you saw this candle after it has formed, you can just easily place your order and sell. Maybe put your stop loss here. But if you're using a 1 hour chart, you need to wait, after it takes 1 hour for the candle to form, and then after that 1 hour, you have to come back and look whether it has started, whether it actually completely formed, or either you sit in front of your chart. So I know we all have a lot of things to do, so you might not be able to just sit in front of your chart as you're doing what you do. So these are the the three major type of candlestick formations. Now I created a PDF to explain these three candlesticks, especially how to identify them, how to buy or to trade them, entry, exit for stop loss, and entry for take profit. So what you might want to do is drop your emails in the chat box, and then after the class, would I'll send them to you so you can have them in your inbox and review them, and then it will now what we've talked about will now make more sense to you. So price action trading is actually a very powerful trading method because it enables you can just look at what price is doing. In this case, you're not concerned about economic news. You're looking at you using the action of price on your charts to make your trading decision. So when you see candlestick formation at areas of resistance or support that you've been looking at, then you probably have a good trade in your hand and you might want to enter into the trade in the direction of the candlestick formation is telling you. So now then take your questions. I know they probably will have a lot of questions. So you might want to drop in your questions. So if there's something that you would like me to clarify or explain that makes sense or that you okay. Or if everything is clear, that would be awesome. It means but if there's something that is not clear or that you want some clarity on, you can feel free to ask your questions now. So are we all good? And what I wanted you to do is to ensure that you're, working on all of these things on your demo. So you're testing these things out on your demo account, because that will be a way for you to practice. You need to practice. You need to practice and practice and practice and see how it works so that you can be able to identify them clearly. So when you're able to identify them clearly, you'll be able to become a better trader. So on your demo, because you're using money that is not real, you can, and it's the same chart. What you see on your demo is still what you see in your life. So if you get better on your demo, you'd also invariably become good on your life. Although they're not exactly the same thing because there's emotions attached to life trading, but that would enable you become a much, much, much all-round better trader. Okay, so okay, you said I want to understand something. I see you talking about selling when the price is low. So that would be a misunderstanding. When the price is low, at low prices we're looking to buy, and at high prices we're looking to sell. Now, it doesn't mean when the price gets to a low price you start looking to buy. But when the market shows you that it is about to start going in the opposite direction, then you start looking to buy. Now let's use our chart to explain. Now, just take a look at this chart. You can see the market is coming down. Now, if you see a market that has been trending lower, that means it has been coming down for a long time. If the market has been coming down for quite some time, then you should be looking for opportunities to sell. But you're not just going to sell at any price. You wait for the market to make a high price and then you sell. So in this case, the market has been coming down and then it made a high price and then we'll be looking to sell. Then you see it moving down, pulls back, make a high price. What I mean by high price, it's remember we say the market does not move in straight lines. So the market always moves in wave. So let me see if I can draw my screen. So you have the market moving. That's too big actually. Let me clean this up. Okay. I think on my pen not too big. So you can see the markets moving in waves. So you can see the market, forgive my drawing, but you can see that the market is not just making straight line movements, it's moving in waves. So in this case, we'll be looking to sell at these high prices. Well, now we'll keep as long as the market is moving downward, we're looking to sell. But you can also buy, although you need some more experience to buy the dropping market when the market makes those turns. So in this case, when the market makes it makes a let's say forms a bearish pin bar, a bullish pin bar here, then you might not look to take the trade. Or and then if the market is like here in this case, you can see the market made a very big bullish candlestick here and pushed price up. So you can trade this even though the market is coming down, you can buy up to this point and then sell down to this point. But that would be much more technical. You'll be better off focusing on the direction of the trend. When we look at support and resistance and trend, you would now be able to you'd see why it's best for you to trade in the direction of the trend. So if the market has been making higher tones, you are better off, you're better off buying the market. And the market has been making lower lows and lower highs, you're better off looking for opportunities to sell the market. And that is so that is all that will also influence your decision of you might see a bullish candle formation, but because the market has been in a bearish, the market has it's been bearish for a while, you're better off avoiding signals that tell you to sell when the market has been, sorry, to buy when the market has been moving down. So let's say, for example, you can see here that the market has been going down, but after getting to this low price, the price market actually struggled going lower. And you can see how buyers started taking price up. Now you can see a bearish pin bar from here. If you've traded this bearish pin bar, you probably would have taken loss except you exit for maybe small profits here. Now this is because even though this is a bearish pin bar, it is forming against the trend of the market. Up until this point, up until this point here, the market has been coming down. But then when the market started trending higher and cancelling out the highs, you can see this was the previously high price. So in a down market, you're looking for the market to make another high price that is also lower than the previous one. But when it now takes out this high, it now signifies that man buyers are serious, so they are not ready to go down anymore. So it now start pushing price up. Now, if you now decide to trade this bearish pin bar here because you saw a bearish pin bar and you do not consider that the fact that the market has actually cancelled out the lower lows and the lower highs, then you might be in some loss. And here you'd have definitely gotten taken out somewhere here for loss. So in this case, once the market is moving higher, you're better off looking for opportunities to buy the market. Okay. Another question. Okay. Do we have any other question? Oh, so you missed what I was explaining. Anyway, the point is you're looking to buy a market that is rising. But in buying the market that is rising, you're looking to buy it at low prices. So the market is always making higher highs and higher lows. So if the market is dropping, you're looking for the market to drop and then form a high price, so you sell. Drop, form a high price, and you sell. The same thing, drop, form a high price, and you sell. Now, once the market stops forming high price and high, you now start looking for opportunities for buying. So once the market stops forming, okay, once the market starts forming high price and low price, high price in a downtrend. So if the market is moving down, you're looking for it to form higher highs or lower highs. So in this case, it's come down, form a high. By what I mean by high, you see it pulls back up. So this pullback here is what we would sell, and then this pullback up here is what you would also sell. You sell this pullback. Now, once the market is moving upward, you'll be buying the pullback. So it makes a high price, come down, you buy the pullback, makes a high price, come down, you buy the pullback. Now, is in this pullback. So in this case now, we'll be looking for any of those our candlestick formation, but the one that tells us that the market is going, that gives us a bullish indication. You'll be looking for pin bars, engulfing bars, inside bars that tell you that the market is pushing higher. When you get more experience, you understand how to trade reversal, because as you can see, the market never goes straight up or straight down. So at some point, it's going to reverse. And what you want to do is practice, practice, practice. Use your demo. The more confidence you get on it, the more you'd have a better strength in trading life. So you want to for now, for today, focus, look at your chart and look at all the candlestick formations we talked about and see how you could have traded them. And what you're looking at is how you could have traded them and what you would have probably where you'd have put your stop loss, where you'd have placed your take profit. If you see a current one forming, take the trade on your demo. You know, that is how you make progress. That would be the much we can take. A recording of this would be made available so you can always go back and watch it. I'm looking forward to okay, yeah, sure. That should be tomorrow. So tomorrow we'll look at support and resistance. Very, very interesting. You don't want to miss that. So you get even if you're new to trading or you have some trading experience, you don't want to miss the next lectures on support and resistance because then the chart will now start making sense. You'll be able to see what is going on in the chaos. So it's making sense of the chaos is how we make money in the forex market. So you'll be able to see how you can make sense of the chaos or the zigzag movement of the markets and how you can profit from it.